you're always going to need some level of active income to feed into your passive income until your passive income is enough to create financial freedom. That's the whole goal, right? So again, I'm not patient. I've said it before on the podcast. Everybody who knows me, I'm not patient. I'm not sitting around and waiting for those things to happen.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi, everyone. I am Jason Balara, and this is the Know Your Why podcast. It's actually a special episode. This is the 400th episode of the podcast, which, frankly, I'm not sure I'd ever be at 400 when I got when I started this whole thing. Through encouragement of some good friends, the podcast started, and the first 50, probably even 100 were a grind. It was worrisome to even invite guests. So all of it caused some anxiety, and I think in a good way, pushed me outside of my comfort zone, which was the whole point of it. I still get asked, what does the podcast do for your business? What do you, and we're 400 episodes in. I'm not, I've never tried to monetize. I've never tried to do probably some of the things I should do realistically from a brand standpoint, but it's just not why I do it. I enjoy the conversations, and I enjoy all that I get to learn. It's kind of a free chunk of time with some very, very successful entrepreneurs in real estate and business and all of it. And so I guess I would just start by saying thank you to all of my past guests. There've been so many. Really only a handful have been on more than once. So don't have 400 guests, but probably have at least 350 people that have agreed to come on the show, give their time up, and sit here and have a conversation with me. So I am extremely grateful for all of that. I'm extremely grateful for, those connections that the podcast has created for me. So I guess that's the answer to the question. What do I get out of the podcast? I get that. I get those connections. I love it. I love the conversations and the learning that it provides for me, and hopefully for the listeners as well. And the plan is to just keep on going. This is not the last. It's the 400th episode. It's not the last episode. So definitely excited to continue and meet more great entrepreneurs and have more amazing conversations. What I wanted to talk about today in terms of topic is actually a bit about our fund and why I structured it the way I did, but also why and mainly why I find investing in small business acquisition such a appealing route at this moment. So first, the fund, if you listen to this at all, or you've been on any of my social media or what, you probably have heard something about the Lark Veterinary Impact Fund. It's the fund structure that I came up with that basically the idea is that I want to create a structure that provides good returns, which also includes cash flow, to our investors. And I think that the challenge we face in real estate right now is a lot of deals just aren't cash flowing well. That's the reality, whether people talk about it much or not. That is the reality. That's our deals that we directly manage. That's deals that I've invested in as a passive investor. There's a lot of just headwinds in the space, and has been for a couple of years, and that's pretty normal in real estate and market cycles. So it all goes up and down, but overall it goes up, and so it's just a matter of riding out the storm and carrying through that. I say that like it's been easy. It's easy to say. It's been much less easy to do. The focus is constantly on improving performance of our properties and improving the I guess long-term outlook for our investors. That's really what it comes down to. All of that contributed to why I created the fund structure that I did, in that we can sort of marry real estate and small businesses together. Real estate is though it's maybe short on cash flow right now, it's still very good. There's still very good tax benefits. There's still a lot to be anticipated from appreciation over time, and ultimately cash flow will come back up. We have had a great deal of new construction these past couple of years, and but not a lot of that coming online. So there's been a lot of absorption. That absorption has not completely happened, but in a large part has happened, and that slowed down rent growth. And if not, even knocking it back a little bit. But the next couple of years, we expect that to pick back up because it's entirely a supply and demand game. And right now, the supply is still below the demand. We still need a lot of housing units in the US. So uh, certainly things to come, good things to come in the real estate world. I'm really believe that, and I think history has shown us that that is true. That after the storm, we can have some good times. So we hang on for that. But I didn't want to just sit around and wait for that to happen. And so, really, the first piece of that was I ramped up my veterinary business. I really leaned into how to create an efficient, successful, profitable business, uh, using as little time as possible, right? Of my time. And so I've done that. I've done that with veterinary business. It's pretty dialed in now. I'm very happy with how much how much time I spend doing surgery. I have great teams. I have great teams in my veterinary business. I have great teams in Lark Capital. I have great teams on the real estate side. I think that is the key to success. And my observations while growing the veterinary business was, okay, what's different about this than with regards to real estate? What's different about a business, an operational business, than owning real estate? And mainly what it comes down to is speed. And for me, that's a huge key to my success, and speed and efficiency. And so when we're running, if I use my surgery business as an example, when we're running a surgery business like that, we have a lot more levers that can be pulled that can result in changes in a short period of time. And so contrast that to multifamily real estate, where we in an ideal world, we find a great tenant, we put them into an apartment. That resident stays, they pay rent. That rent's generally locked in for a year. So there's not a whole lot we can do once we get past that early value add phase that can really dramatically increase the day-to-day profitability of the property, which is not a bad thing. That's stability. That's over the long term. That's where we want to get our passive income to, but we need to make money to put in those positions. So you're always going to need some level of active income to feed into your passive income until your passive income is enough to create financial freedom. That's the whole goal, right? So, again, I'm not patient. I've said it before on the podcast. Everybody who knows me, I'm not patient. I'm not sitting around and waiting for those things to happen. And so, I started to look at, what can I do to add to my real estate portfolio, my business portfolio, which at the time is the veterinary surgery business. What can I do to add to that? And I started looking into acquiring businesses, and so that's been a big focus. I've learned a lot over the last year about that process. One is it's actually quite different from purchasing real estate in a lot of ways. Most of the businesses, unless you're a large private equity firm buying $100 million businesses. Most of these smaller businesses are, mom and pop owned. They may not have great financials. There is a lot of emotion involved in those transactions, uh, particularly from the seller side, right? They started this business. A lot of them started the business from scratch and may have owned it for 20, 30, maybe even 40 years. And honestly, those are the businesses you want to buy. For those sellers, it's become very much a lifestyle business, and so they haven't tried to grow, but they've reached a point of revenue and profitability that's very comfortable for them. And so it does get a little bit stale, but at the same time, there is a lot of relationship capital built up in these businesses. And what I mean by that is the owner's relationships with their employees, the owner's relationships with their customers, the owner's relationships with their suppliers, all of the day-to-day dealings that happen in a business uh, at that level is very personal, really. And so it's nice. It's nice. You need to find a seller who you can find that relationship with. And certainly depending on the industry, that mm, the importance of that relationship with the seller varies. But my background outside of veterinary medicine is in construction. I just very recently passed the California state contractor exam, so I am a couple more pieces of paper to fill out, but I will be getting my California license in hand over the next month or so. Um, that creates credibility for some of the sellers in this industry, in the construction industry in general, and allows me to speak their language. I understand talking with laborers at their level because I've been a laborer plenty of times. Um, but also now, I've owned businesses, I've run businesses, I can hopefully relate to people at different levels, but ultimately that seller is a huge piece. In real estate, most of the transactions are just that, transactions, especially in the syndication world. So, someone wants to sell something, you want to buy something. If you can come to a agreement on the price of that exchange, then here we go. We process all the paperwork, we move through that. Closing day, most of the time, we just walk away. We shake hands and walk away, and don't really have a continued relationship with that seller. It does happen. It does happen, but most of the time it is very transactional. And in the business world, it seems to be much less so, which is actually interesting but different to navigate. Um, and so you have to be able to wade through that. And I'm as I've learned that, what I've realized is it generally it takes longer. It has taken longer to get a business acquisition into the fund than I would have liked. However, it's also better to do a great deal than to do a bad deal. And so, just finding the right space to be in, I think is really really key. And again, the reason I want to add businesses to the portfolio is to provide a different piece of the puzzle when it comes to investor returns. And frankly, I invest in my own deals, so it helps me too. But essentially, find something that we can grow. And in a lot of cases, that growth is really going to be tied into the seller's existing relationships and your ability to kind of slide into that hemisphere is probably the wrong word, but slide into that ecosystem is what I'm looking for that they've created amongst suppliers, and then figure out how to freshen it up, how to create new opportunities, how to expand territories, how to maybe make the employees' lives actually better. It's all an option, and I think that that's the beauty of it's truly seems to be an art in a way, as much as a science, where you have to figure out how you're going to fit yourself into this world of relationships that the seller has created. So it's it's exciting. I am really looking forward to this piece. I've had a lot of excellent conversations with potential investors. I've had a lot of conversations with sellers and with brokers on the journey, and I've enjoyed all of it. So I look forward to continuing that and really finding the right business, which we just went under contract. I mean, this when this episode airs, we will probably have been under contract 3 to 4 weeks on a business I'm really excited about. I'll I don't need this podcast episode to be long. I don't need to go on a rant, but I will leave you with this little piece. You can call it mindset. I don't know that mindset is exactly the right word, but it sort of came to me as I've been going along this journey. And so, when you buy a business, I mean the same thing. When you buy real estate that that's supposed to be something that you're going to rent out, you're looking at comps, right? So I'm buying a business. I'm looking at comps in the area, but I also started looking at what is the market for this product. And it came to me because I looked at a company, a scaffolding company, which is an extremely niche construction market, but seems to be actually a very lucrative one. And so I started looking at, in this industry, who are the biggest players, and come across, whether it be a publicly traded company or a private company, whether they're just in the US or international, but you can really look at those top performers in that space, whether it's like I said, a scaffolding company, a roofing company, electrical company. It doesn't matter. It doesn't matter the industry. Take a look and see, if you're going to launch a new type of cell phone, you better look at what Apple's doing with iPhones. That's the kind of thing, I think. And not that you're going to design another iPhone, but just, how did they get where they are? Where are they? And what piece of that pie do I think is attainable? And so I looked at it as, okay, I look at these companies that I'm looking at. I look at the biggest competitors. I look at the biggest competitors in the market just to know who the direct competition is. But I look at the biggest competitors in the country or the world to know what the total market for that product could be. And so, using that example of the scaffolding company, I looked, and there's a large scaffolding company that's worth $6.1 billion, or 6.7 billion dollars. And I thought to myself, well, what if I created a company that was 10% as good? What if I created a company that was 1% as good? 1% in my mind that's a low bar, right? 1% as good as, one of the top performers. I don't even want to be 1% as good. I want to be a lot closer to the top. So, but if I look at it as 1% is an achievable threshold, 1% of a $6.7 billion company is a $67 million company. I would be happy to own a $67 million company. That wouldn't make me sad. It doesn't have to get that big, but putting things into perspective and realizing that that's a very achievable opportunity, given that someone else did 100 times that. We can do that. We can do that, and I believe it. I believe that we can be. I believe that I can be 1% as good at anything as anyone. I just it's a maybe that's a silly belief, but 1% just doesn't seem that impressive to me. So that's the goal here, is to become rise to the top through performance. And there's a lot of different ways to rise to the top, but I've been able to think about this a lot and realize, what works for me. What is my strength? What is my superpower? I'm going to rise to the top through performance. That's really what it comes down to. So, might take me longer, but I'm going to get there. So, I truly appreciate you listening. Truly appreciate all the guests that have been on the podcast with me. I know that your time is valuable, and so thank you very much for sharing that with me and my audience. And I hope that the folks listening will continue to listen. My request is please like, rate, and review the show so we can keep having great guests and growing our reach to more people. I hope that we provide some level of educational content to those of you either looking for investment opportunities or looking to be an entrepreneur yourself. Please reach out, connect with me. I'm always happy to have a conversation. So again, thank you all for listening. I look forward to the next conversation. Take care.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?